Welcome everyone to today's webinar titled Mastering Accounts Receivable Strategies to Optimize Working Capital Management. This is Brian from Strategic Treasurer, and we're pleased you could join us as we discuss how effective accounts receivables practices can drive working capital optimization. Our speakers for today are Anthony Mignogna, Vice President of Strategic Solutions Engineering at Corcentric, and Craig Jeffery, Founder and Managing Partner of Strategic Treasurer. Welcome, Anthony and Craig, and I'll now turn the presentation over to you.
Thank you so much, Brian, for the intro, and thank you everyone for spending some of your evening, afternoon, or morning with us. Anthony, it's good to present with you today.
Yeah, you too. It's been a minute, Craig.
It's excellent. So we have a lot to go through, and I'll start us off with our agenda. So on your screen, you should see our topics of discussion. I will start off with accounts receivable. So what's the role and impact? We'll look at efficiency, scalability, and capital. So you'll hear some things about the cash conversion cycle, the working capital impact, and we'll take it from a position of accounts receivable and treasury. So both of those will be joined together because they are connected in the cash conversion cycle. Then we'll look at working capital management, some insights from your peers. So there'll be some emphasis and focus on survey data, what others are doing. That can be an indicator of things you may want to consider, or at least know what others are doing. Then on the challenges, if you're in finance, you know there's lots of challenges on AR. There's delays, disputes, the process can be broken, there might be a lack of visibility. So if we look at what are the areas of opportunity, opportunities are set aside or opposite the challenges. Then we'll look at receivable strategies. So how do we optimize working capital? And again, that phrase optimize as opposed to maximize or minimize is important so that it's broadly shared depending on no matter what your organization is. Optimization is the key. But we'll look at 4 parts in that section. We'll look at the people, process, tech, but also the capital or finance section of that. So that's a key component. Then we'll look at comprehensive considerations. And on the comprehensive considerations, we will have a Venn diagram. I know many of you are looking for a Venn diagram, but this will be used to aid in our understanding of, as you look at what are you trying to solve and what kind of tech solution fits depending on what areas you're trying to solve. And then finally, we'll do a wrap up. Anthony will take 2. I'll take one of them. We'll go cover visibility, partnering, and some of the opportunities for improvement that exist. So that's our agenda. So thanks for coming, and we'll get started on this. I'll start and then ask Anthony to weigh in. Now, excuse me. Now this chart has treasury at the center, and that's my problem, right? Because I love treasury probably more than the other areas, even though I love each of the areas quite well. But this cash conversion cycle is, people are converting cash to, let's say, buying materials, goes into inventory and they're sold. Of course, your business may be more service oriented, but there's that key accounts receivable section, which is highlighted in blue. We just put treasury in the center there because they're concerned about the cash and the cash conversion cycle, because that impacts liquidity and the balance sheet and every single touch point. So they don't necessarily do inventory or accounts payable or accounts receivable, but all of those relate to the liquidity look. So from a treasury perspective, accounts receivable is a huge portion of that, a massively important component of what treasury is looking after. AR has a lot of things to look after as well. Anthony, feel free to jump in on that or cover any of the other areas too.
Yeah, I mean, fundamentally, cash flow is cash going in, cash coming in, cash going out, right? So accounts payable is cash going out, accounts receivable is cash coming in. And as we'll kind of dive into when it comes to AR, it's a resource intensive process. There's a lot of intricacies and variables, right, that need to be balanced, and there's a lot of uncertainty that, the clearer picture you can get of cash coming in, the better treasury can plan for, whether it's maintaining liquidity or flexibility, right, or kind of working down the list of investments or operational improvements that an organization wants to make, or, for small organizations, it might be as simple as just making payroll. You know what I mean? So it's pretty important, right, to get paid for what you've sold.
I think that's really important what you said, Anthony. The language that we use, depending on our organizational size, is very different, right? To focus on, I need my liquidity, meeting payroll, or meeting those other current demands versus a broader view and optimizing the overall process there. Everyone's involved in the same thing, but we might use some different terms. So since we're talking about terms, I'll go through a couple of the terms just to make sure we're using the same language, or you understand the terms that we're using. So as you listen to this and you hear the term working capital, if I were to say, do you want more working capital or less? And your answer may be more, less, it depends. But let's go through the terms, because the definition that's used will matter to how you describe it. On the left-hand side, you can see this working capital, the accounting definition, or the bank definition. This is current assets minus current liabilities. That equals working capital from a banker or from an accounting perspective. So, and that really is a measure for understanding how you meet your obligations or bills or payments or servicing debt as it comes due. Now that's a helpful feature, but when you think about current assets and liabilities, if you change a receivable to cash, they're still current assets. There's no difference there. And so this is not the definition of working capital that we're talking about when we use the term working capital in these discussions. We're going to use working capital, which I've expanded over here on the right side to say net adjusted working capital. This is looking at AR plus inventory minus accounts receivable. So that is a total view in terms of value that shows how you move money, how much capital is tied up in AR and inventory, and how much are you using from others' balance sheets on the accounts payable side. So this net adjusted working capital, or working capital, depending on how you're using it, shows how much of that capital is tied up in the business. And so the idea of, do you want more or less? The goal is to optimize working capital, not just maximizing or minimizing. Maximizing working capital on the right-hand side means get slower on AR, build up your inventory larger. Minimize means no inventory, don't extend credit. So this idea of optimizing is important from the business perspective. We just say all that for the context because we're talking to AR professionals and treasury professionals, and we're going to get deep in the accounts receivable side. So just want to lay out those markers so that we're thinking about that in our discussions. So with the definitions covered, we'll go into a couple slides of data. I'll jump here, and if you want to comment on any of these, Anthony, feel free to jump in. But charts are interesting. Depends on where you start them. So if you look at them, it looks very volatile between year to year, but you can kind of see that the year price starts, or the y-axis starts at about 50%, and so it looks very dramatic. But what happened in 2020? Well, COVID-19 caused the organizations to place a much heavier emphasis on working capital. Well, that diminished in the subsequent two surveys late last year. That increased and came back to the same level, right? Concern. Election year always creates concerns about volatility, changes, unsure what's going on. But the real key takeaway is not that it moved 10 points from 2023 or from 2020 to 2025. It essentially stayed the same. It's that it's back in vogue. It's heavy. Organizations are focused on it, and that's another reason why AR is so important. 2/3 of your peers place a heavy emphasis on that, and I imagine maybe even more of you do because you were at a webinar and having a discussion on this exact topic. All right, so I'll keep going on this. I'll start on this one, and then Anthony, you can jump in. So what are the primary areas of focus? The left-hand side, the green, 2/3 receivables management, payables management, slightly less. We'll get down to inventory, borrowing, supply chain finance, quite a bit less. Yeah, feel free to jump in, Andy, on any of these. I can come on
Yeah, I
to.
mean, I think, going back to your last one there, right? It's between 6 and 7 out of 10 is kind of the range, right? But what causes that 10% more is it's going to be uncertainty, right? Which I think will kind of be a little bit of a theme as we talk through different ways you can optimize working capital, or we like to say unlock the working capital that's tied up in your AR process. But I think that's kind of the common theme. And when if sorry, you can go back to the next one. Um, the left side is, how are you trying to improve that working capital management? The three vectors of that cash conversion cycle are receivables, payables, and inventory. But the most common, or I guess maybe the most opportune areas are those two at the top, right? Receivables and payables. Those are the ones that typically can be affected with business process improvement and things like that. Whereas inventory is kind of managed. I mean, business process is a piece of it, but there's a lot more to inventory management as well.
Yeah, I think the other, the right-hand side, what's going on with working capital, what's been improved, looking at both things, it's really interesting for us to see that over time. Anything else on this, Anthony, or should we continue to move to our first poll?
I think it's interesting that majority, it looks like, if I'm adding this correctly, have improved working capital over the last 2 years. And the majority of that improvement is from internal initiative, which I think is kind of what I was getting at a little bit before, which is, there's real ways to impact your cash conversion cycle with, not simple, but internal improvements and optimization from a business process standpoint.
Yeah, great observation. Yeah, so that's 58% improved it, 24% were the same. The remainder is saw deterioration or they're unsure of what goes on. So we're just trying to show that focus on where did people see improvements. There's certainly a lot of focus on it, and most have experienced improvements. Okay, that brings us to poll question number 1. This is a multiple choice poll question. And I want to spend a little bit of time on this. We have what are your organization's top challenges in AR? Late customer payments, high DSO, customer credit risk, disputes or billing errors, limited visibility into receivables data, other or unsure. And so we'll give Ray just a few moments to answer that. So as you can see, if you type the word Corcentric, if we get 100 people typing the word Corcentric, we will send all the poll responses, the aggregate report, and stick that on this page. So we appreciate everyone knowing exactly what to do without instructions. There's also, if you can't see the poll, Brian will paste that in again. There's some instructions about alt tabbing or trying to get behind the screen to figure that out, to see if you can locate it. All right, before we show it, Anthony, I want you to guess what you think is the top one, right? Because you may know what the top one is for the entire world, but this audience is focused on it. Want to see how good you do. So when he starts to pop it up, I'd love for you to say what you think is the top one.
Yeah.
Is that, if that's not too challenging, right?
Well, I cleared the answer, so I kind of forget some of them, but I would guess late customer payments is going to be my guess.
Okay. And you nailed it, right? It was close for limited visibility to receivable data by 3 percentage points, but you nailed it. So yeah, so as you look at some of these challenges, because we will talk about some challenges in just a little bit, but maybe you could step through some of these in terms of priorities, because this was all that applies. So somebody could have selected, 2, 3, or 4 of those. None of these is 50%. So any thoughts on this data that you see?
Yeah, a couple things. So I would say that from a aggregate, I wouldn't say global, but just from a general standpoint, the some of these, I think, probably ebb and flow with macroeconomic conditions, right? So customer credit risk, when you're kind of recessionary, is going to probably be a bigger problem than not. But I do find it interesting. Late customer payments is typically the instigator for we need to figure out how to solve this, but that's one that involves multiple third parties. It's extremely complex and it's very difficult to improve. And you can improve it with some of these other things like reducing disputes and increasing visibility, which are not easier to do, but they are something that you can do as an organization, whether that's through investing in software, whether that's through investing in third parties, outsourcing, et cetera. So the fact that limited visibility was kind of in the top two there, I think is kind of interesting to me. The last thing I'll say is the high DSO, is could be kind of a terms problem, right? Where, you're just, for whatever industry you're in, your aggregate net, payables is 75, 80 days or something like that, 90 days. Right. But it also can just be a consequence of, depending on how you're calculating it, right? Just a consequence of late payments. They're kind of one feeds into the other.
Yeah, excellent. So the disputes or billing errors, those are types of defects. Those all have a feedback into DSO or late customer payments at a disproportionate level. That's one of the things I find most interesting. How defects, like if you had 3% defects, 3% of your DSO doesn't move out a week. It moves out much, much more dramatically, and so it's a disproportional impact.
Yeah, but if you group that and then one below it, right? Disputes, errors, visibility. That's about 65% of people have that. That's 2/3 almost. I know I'm rounding and then rounding again, but I'm in
Well,
accounting. I get to do that. But
it is an all, you can select all of them. So some of those could be duplicate. It's possible they're completely non-overlapping, but
yeah,
prob
that's fair. I guess my point was my point is those are process problems, right? Those are from a people process technology standpoint, like those are things that are fixable, right? Which will then in turn impact the top two of like customer payments and high DSO. So if we're talking about like where to prioritize, I would look at that first.
yeah, great points. Thanks everybody for responding to the poll question. This is so useful to us. And for those who are keeping track of how many people had responded through the different channels, it looks like we need like 34 more Corcentrics to share these with everybody. So that's where we stand. We're going to spend a little bit of time on this chart, not a massive amount, but some. This is a kind of a snaking order to collect process. So if you look at it, we have this is the flow of what goes through. I'll start. Anthony will dive into this in some detail about how to think about some of the different components, but order to collect, right? The money comes in and it's collected. You've got some of these different steps about, we confirmed credit availability, we shipped it, we invoiced it, scheduling, planning for the money, determining when it's coming in. If there's a dispute or an error, there's a correction process, and there's a loop, and then payment and information may come in together. They may come in separately. So there's the cash application, applying and assigning it, assigning it to an individual vendor or a customer rather, and then applying it to individual invoices, and making sure that that's closed off from the start to the end. There are a lot of different parts here where things can go wrong that can be manual or can be automated. So yeah, this is a lot of opportunities for inefficiency as well as for efficiency. Maybe you could, continue the flow. And what are some of the areas that you see as most crucial in this stylized flow here?
Yeah, it's like Step Brothers. So many room for activities. So many opportunities for improvement, right? Because there's so many points of failure. I think, from a just being at Corcentric, we kind of we have AP solutions, we have AR solutions, so we sit on both sides of it, right? One of the most common issues is either the order is wrong, right? So what I put on, as the buyer, what I put on the purchase order has the wrong price or the wrong part number or, whatever. Or the invoice is wrong, right? It's like I ordered, 15, widgets for $10 and I got billed for 10 widgets for $15, right? So just that transaction of, an order being placed in a corresponding invoice is certainly an area that is, ripe for error and inefficiency. One of the biggest problem statements we hear from an AR standpoint is not so much, I have problems getting orders or generating invoices, is getting the invoices into the systems that my buyers want me to put them in, and making sure I'm following the rules so that they're received and that we can get paid, right? So there's sometimes a gap between just generating the invoice and the customer receiving it. So just cleaning up that transaction where you're getting accurate orders efficiently, digitally, and you can, turn them into, efficient, digitized, delivered invoices. That's going to help a lot. And then, that's going to also reduce that whole dispute process, right? Because the dispute process probably creates the biggest lag between, invoice and payment, because obviously you got to kind of resolve it, right? So, a lot of times the person who bought it is not the person who's receiving it. The person who's managing the billing dispute is not the person who sold it. As organizations get bigger, and so that dispute process is hard to necessarily improve that process itself. It's, you kind of just don't want to end up in it, right? So curing kind of the transaction is probably one of the biggest things you can do for, what we were talking about in the survey, the billing and the billing issues and disputes. But having visibility there is going to help as well. And then, my favorite's the wrong way to say it, but the what did you pay me for, right? When you finally get through this entire process, and somebody cuts you a check or puts the ACH in and it doesn't line up to a single invoice, you got to figure out which collection of invoices they paid you for. So cash application is one of those kind of hidden details of inefficiency that are pretty tough to solve if you don't have kind of that upstream process clean and digitized.
Anthony, you said something I thought was really pretty interesting. We didn't show all the complexity of this. This is a simple, hey, linear step. Maybe it's not a line. It's
Yeah,
more like
sure.
it looks like a big two, but you mentioned, hey, we send invoices. Well, it used to be people would print invoices, then you send them digitally or as PDFs. And then the AP group, right? There's another webinar going on right now, probably about the order to pay. And they're like, we want those invoices loaded in our system. We don't
Mhm.
want we don't want the mess. We want it, we want less errors on that side too. So this whole process of invoicing is, getting invoices into the other counterparty system um, efficiently and accurately.
Yeah, and it's the more customers you have, the more complex it is, right? You have a dozen different portals, you gotta have 2 dozen different portals, and all of them have different rules, even if they're the same portal, right? So it's certainly not easy to do, for sure. And it's often, one of those kind of, like I said, overlooked, probably a strong word, but it's maybe underappreciated, the complexity that goes into that.
Yeah.
Step.
Yeah. How many different portals people load things into. And I think AR understands that, lives that very
Mhm.
on a day-to-day basis. Treasury sometimes is like, what do you mean? You have to load to 10, 15 different portals. There's all kinds of different rules and timing. And if you get something wrong, it starts the process again. It starts the clock again.
Mhm.
It can become like this, not a black hole, but this, a delay hole, right? Any change
Right.
means the clock resets. Yeah.
Yeah, and then you're kind of balancing delay versus operational resources, right? Like you can throw more bodies at it and get it done quicker, better, faster, right? But now you're increasing your operational cost for AR. So it's always the balance.
Thanks for that. The other thing just to notice visually for everybody who's on listening, we've got customer and company with black and blue, and you can see how it shifts back and forth to different ones. If we started putting in some of the system interactions, there would be more. I guess we could put this in a swim lane chart, but then it would be even smaller. But that idea of there's all these handoffs, every single point of handoff is an opportunity for inefficiency and error. And so that's where we have to look to say, how do we solve that and manage that effectively? And so we've given everybody a bit of an intro into some of the challenges. But Anthony, maybe you can take us through some of the challenges. You've touched on some of those. Maybe even giving examples make sense. And then how do these challenges ripple into the different implications that we want to avoid?
Yeah, I mean, I think if I'll just kind of sit on the invoice example since we were just talking about it, right? The AP side has a way that they want to receive invoices, and the AR side has a way that they want to provide those invoices. And that's based on everything that's upstream and downstream of those two individual processes, right? And so getting those to match is really difficult, and getting those to match, as a one-off is really not that hard, but when you have to do it at scale, that's where it becomes difficult, right? And so what that creates is, the inefficiencies, right, that we talked about. It's going to create delays because the error, the issues, the errors, right? Every time you submit the invoice wrong, it restarts the clock. It's going to cause operational costs, cost issues, right? With as far as the more outstanding AR that you got to manage, the more people you need to manage it. And it's going to impact your visibility, right? And I think from a treasury standpoint, cash flow, the inbound cash flow, there's the amount. Nicholas had a good comment. I thought it was fun. There's an amount to it, but there's also a timing to it. And I think, having the more certainty you can have around that timing, the better you can plan. And so, whether it's in 60 days or 75 days, obviously, the sooner the better. But I think if you can guarantee payment on a specific day, that that money's coming in and what it's for, is really helpful from a treasury standpoint.
You mentioned that I remember, medical insurance bills, and you get these statements, on the personal side, you get statements saying, hey, this is going to be paid in like 98 days. It's like, it's approved and it's scheduled out 98 days. It's like, that's good and bad. Bad so far, good in that, hey, they know when it's coming, they know that it's approved, and there's some aspect of that. So that's pretty interesting. One of the things I don't know if you had any stats on this, but we've seen, DSO get extended because there's disputes or there's errors, and a very small percentage of errors can lead to multiple days of increase in DSO. Now, people aren't paying early. Let's say DSO was 30, for example, but the collection time might be 42 days. DSO may be 42 days. The expected terms are 30. And we would oftentimes find that about half of that was triggered by a very small percentage of disputes and errors, from the billing process to the ordering, and some errors and distinctions. Do you have any stats on that or any comments on the ripple effect?
Yeah, I mean, I can use an example. I was actually this morning working on analysis with my team for one of our customers that relates to like process improvement, and one customer impacted chronic late payments and disputes can impact their aggregate DSO by 10 days. Right. And obviously there's Pareto principles, right, to big customers and the impact, right. But it's pretty significant. But the good news is like that is one, it's like if you could figure out how to clean up that one process, you can take your aggregate DSO down pretty significantly, right? And so it is kind of it's typically a small percentage. It typically has an outsized impact. But the good news is that, you can, if you have that visibility, you can identify typically where the I gotta get the pop-ups to stop because I keep laughing at people's comments. Pareto test or Pareto is on the test, yes. But you can see the pattern recognition when you have the visibility and identify, hey, if I'm getting chronic disputes, there's probably something wrong with the process, and you know where to look, right? Because that's a lot of times, the visibility problem means like I want to improve my DSO, or I want to improve my AR process, or I want to, but I don't even know where to start. And the visibility helps at least tell you where to look, and you might find that 9 out of 10 orders from this customer have the wrong price or the wrong item number, and you can actually help them update, the ordering on their side, which helps you with the AR on your side.
Yeah, excellent. So Pareto principle is the 80-20 rule. Sometimes it's 11-92. 11% of your customers result in 92 or 93% of the activity. I don't think I've ever seen actually 80-20, but it certainly is a smaller amount, has a disproportional impact. All right, that brings us to poll question 2. Everyone's waiting for that. Here it is. This is a select one. Which strategy would have the greatest impact on improving your receivables performance? We've got everything from automation and technology adoption down to other or unsure.
Cool.
Give everybody a chance.
This one's a tough prediction while everybody's answering them.
Yeah.
I feel like the other one I had it like right away. For this one, I'm debating.
And Brian's going to let us know. I think we need 20 more people to type in the word Corcentric to share all that, to share all the results of the polls. That's just how we operate. I do love the engagement. So everybody who types those things in and engages with questions, thanks so much for doing that. That's fun. We love having good content with great companies who share their thought leadership, and a wonderful audience that's on top of these things. And so thank you for coming. Thank you for being part of that. And thank you for completing our 100 Corcentrics in the box. Awesome.
Yes, and for those of you who said, I'm glad we're not the only ones that struggle with this. You're most certainly not. Even large organizations that look like that, seem like they've got it all put together, struggle with accounts receivable. It's a complex process. Oh, I didn't get to guess, but I was definitely going to guess the first one. So that's right.
I was going to guess them all in exact order. A couple things here. Automation and technology adoption. That's the clear winner, because people see so many of the other activities being accomplished through that. But let's talk about optimizing invoice and payment terms. That's number 2, handily. Your thoughts on that? Is that a secondary driver of efficient AR?
So if you were going to ask me the top 3, I would have picked this top 3. And I do think it is, when we just on the invoicing and payment terms, when we think about the multiple points of failure, every new payment term you need to manage is yet another point of failure. Every new invoicing process that you need to manage is another point of failure, right? So I think, and we see this on the AP side too, right? Or it's kind of the same problem. If you've got to manage, 78 different payment terms, like that's kind of hard to make sure to get your billing right, to know which one of those you're picking. Especially when you start getting into things like discounted terms and those, discounted terms for acceleration and those types of things. That creates complexity, that creates cash application, confusion. So I do think that there's value to doing that. Obviously that involves, engaging third parties, right? So that's what makes it a little bit more difficult, but I do think that there's value there for sure.
Yeah, thanks for your comments on that. Thanks everybody for answering the second poll question. And now we're going to spend a little time on key decisions, but let me set that up as well. So it says how to handle default or intentional. What's your default position, or how intentional are you with what you do internally, what you might use a tech provider for or an outsourcer? This will lead to more components of our discussion. I'll spend a little bit more time on the left-hand side. So buy, build, or outsource, what makes the most sense? And when we think about buying, it's usually you're buying tactical, something that's creative that meets your needs or meets most of your needs. This is the normal default. That's the typical default position as you buy, unless you are doing something so unique that it doesn't exist. You need to create something. That's the point of differentiation on top of what your business is, right? Your business is usually fairly unique, but your ability to bill or collect receivables or to do follow-up. Build is going to be a hard position to argue for, to make a case for that, because you're putting capital in, you've got to maintain it. There's a lot of change that's going on. So buy or build. When we get to outsource, what do you outsource? What are some elements that you cannot outsource without having a deleterious or negative impact? So if you're outsourcing functions, like why do you outsource? Because you might be able to arbitrage labor rates. Why do you outsource this? To get additional scale. But we've all seen places where outsourcing works really, really well and where it creates more problems. And so to the extent that you can automate something, that's superior to arbitraging labor rates. But there are opportunities for arbitraging labor rates for certain functions. And then when you come around to being able to automate things, you're automating stuff that was already outsourced, something that may not be core to your business, but you needed great scale. So this investment decision looks at what's changing in our business, what's growing rapidly. How do we ensure that we're doing two things? One, on the AR side, how are we becoming more efficient over time? Because efficiency is a key driver. That's one. And the other is the capital question. What will help us continue to do well on our DSO or do well on our collection activity, that we can get the funds in quickly in a visible way? And all over, how does that support our work with our customers who are paying us, that we support that activity? So those are some of the key investment decisions. Anthony, feel free to jump in on that, but also wanted to then you to cover some of the control position, and we could have a little bit of a discursus on that.
Mm-hmm. Yeah, I mean, I think so the poll question had software number one, which is, I think, kind of, it's 2025, right? There's probably an app for that. It's kind of the general ethos for most things. And automation's, key and critical to surviving as business. Like it just is what it is. I think the way that I think about technology investments is it kind of it talks about it dovetails into this control position, kind of hybrid or maintain control, right? Do you want a software for you to use yourself to optimize your internal processes, or is this software kind of an enabler, but it might make sense for someone else to operate it, or some combination thereof, right? When we think through that whole little snake process, there's probably a lot of those. There's some things that your organization is going to have to do, right? Like the easy one that I always say is like dispute resolution, right? You're not going to be able to kind of outsource that. But you can certainly leverage technology to facilitate that, improve visibility for that. But a lot of those other areas are things that you can certainly optimize with software and kind of outsource the rest. And I usually use a little 2x2. Somebody once told me that you can summarize everything in business in a 2x2. I don't know if that's true, but I'll sure try. But can you do this well, and do you want to, right? If you kind of look at those steps within that process, when we think about like maintaining control, That's a helpful framework to kind of think through of, can we do this well, and do we even want to? As it relates to, I think the third question on the poll was dedicated AR personnel. A lot of times when we're engaging organizations for, a managed service, it's because the sales team is managing AR, and they would rather than be out selling, right? So that's a good example of when it might make sense to outsource, not just from a cost perspective, but just from a fit and function perspective. So those are some of the key considerations I would look at. I think normally some level of hybrid is probably going to be the answer. It's just a matter of whether that's 10 90 90 10, right, or somewhere in between.
Yeah, thanks. And so everybody can picture in their mind the 2x2. Can we do this well, and do we want to do it? That's the image, right?
Boxes and arrows, that's kind of my thing.
Perfect. I like it. All right. So the headline is cash is king. Couple things on this is what is what supports our organizational goals from operational scalability? How do we grow efficiently as we take on other business lines or take over other companies? Where do we spend our money for growth, making investments, and how does this support our overall financial resilience? So, I'll begin with the operational scalability. When we look at the cash conversion cycle, the working capital number that we showed on the right-hand side was total cash, right? AR plus inventory minus accounts receivable. So that's how much cash is invested into the business process, into that cash conversion cycle, putting it in and then pulling it out as cash. Now that's a key component. There's also an aspect of efficiency when we use terms like DSO, DPO, and days inventory outstanding. So those are measures of efficiency. How quickly do you put stuff into inventory that it comes out? How quickly do you turn a receivable into cash? And how long do you take to pay? Essentially leveraging someone else's balance sheet within that time frame. And so those are all measures of efficiency, and those efficiency measures help us as we think about scale in the future. What will the balance sheet need to look like to support an inefficient, a semi-efficient, or a very efficient cash conversion cycle? So those are a couple of things that are important. And we look at cash as king because whether you're looking at, hey, I've got to get DSO looking a certain way, or we're looking at how much capital is tied up in the business, everyone in finance resolves to that, even if we have a leadership view in our mind of efficiency or just pure liquidity or exposure or risk. That's why we're saying cash is king. And because a lot of our audience is treasury, which always thinks, everybody, whatever area you come from, you always think that's the most important thing. Anthony, I left a lot for you on this one. Feel free to take whatever you want.
Yeah, well, I think we hit a little bit earlier, with the uncertainty, right? Which I think, financial resilience kind of goes hand in hand. So when there's more kind of uncertainty, whether that's, from your specific business standpoint, whether that's your specific market, or whether that's more kind of macroeconomic, cash provides that flexibility, in times of uncertainty. The other way that I kind of think about, when you can unlock some of that, cash that's seized in your AR, it allows you to do more stuff. I think every finance organization, or kind of every CEO, if you will, like has a list of the things that they'd like to do, whether that's capital investment, whether that's expanding product or geographic footprint, whether that's hiring or whatever, what have you. There's always a list, and there's a point of that list where there's not really kind of the cash, the working capital to fund it. And so, the more efficient you can get in your AR, the more of those opportunities you can fund, right, which can help accelerate growth or operational efficiencies, depending on what the target business outcome for those investments are. So A lot of times when we're talking to people about AR, there's the obvious, like, yes, we want to get leaner, we want to get more efficient, we want to get cash in the door, right? But it's like, what do we need to do it for? That's the urgency piece, right? Is the why now, why change, why now? And typically that's to do more things on the list than they can today.
Yeah, excellent. And one thing on here, I'll describe it. We could have put up a chart, but when you're thinking about the impact you have on efficiency, if you're able to, let's say, knock out a day of DSO because you're decreasing errors, you're applying things faster, it makes it easier for the other party to pay you, for example. So let's say it's 42 days and you're able to put some of these changes in. A $250 million business or a $1 billion business, think about that as about at a 1 to 4 million per day. A day of DSO is going to free up $1 million to 4 million. And whether you believe you should use the weighted average cost of capital, which is a reasonable method to use, or a permanent change, which may be 7%, 8%, 9%, depending on what type of business you're in and your credit rating. But it's certainly more than the short-term rate. Certainly more than 4%, which is somewhere in the 4 or 5%, which is what you would use for a one-time change to a particular individual payment. So just some ways to calculate the larger impact on that. All right, that brings us to poll question number 3, our last one. Managing AR processes. How is your organization currently managing AR processes? 1, fully in-house. Second one is partially outsourced, so hybrid, fully outsourced, and evaluating outsourcing options. I hope that covers all the logical possibilities, but we didn't do our 2x2, so maybe we're close. We'll look and see what that looks like. So give everybody a few moments. And we have enough responses for Corcentric, so we're good. If we're not connected on LinkedIn, feel free to send me an invite. I will accept it. If you just want to follow, that's fine too, but happy to follow. And Anthony, if you'd like to share yours in there and you have time to copy it out, feel free to put that in there as well. So, wow. So fully outsourced 1%, evaluating outsourcing 1% as well. So yeah, I mean, there's more that are fully outsourced and evaluating outsourcing options, though it resolves to 1% on the summary. Partially 12%, that's about 1 out of 8. And then fully in-house, very nice. So 72% are there. I think this is good news for Corcentric, Anthony, that there's still a lot of companies that can move to outsourcing or automating more activity. Certainly interesting.
Yeah, I think that, it does kind of tie to maybe the previous one a bit in the typical approach would be first to look for, a software solution that you can kind of manage in-house, right? So you kind of implement it, you use it, you get a nice hit of some automation, some visibility, but it's still your team kind of managing that and you're managing those vendors. So that was, kind of not, I would say not unexpected, right? But I think typically those evaluating outsourcing options are probably going to land in that. But I would suggest that those that are evaluating outsourcing options are probably going to land in that partially outsourced or hybrid model.
Fair enough. All right. Thanks everybody for answering. Thanks for your comments. Anthony as well. So on receivable strategy, I'll start out, but I'm only going to talk briefly on the financing side or the capital side. We look at managing AR across different areas. There's the people, process, technology. Treasury also tends to think about structure, which is where money flows through. But here we're talking about capital or finance. The more your receivables varies, the more you have to tap different sources of credit, either directly from the balance sheet, or doing things like factoring or supply chain financing. All of these have an impact on the cash. So Treasury is always looking to make sure you have enough liquidity to manage that from different sources. But AR, for example, is a huge demand for cash, and it's a supplier of cash. So it goes in and comes out of accounts receivable. So, um, that is a key component of looking at how you manage AR. Where do you do it? How do you do it? What needs to be automated? And how does that flow into the overall impact on liquidity? So that's one of these squares, Anthony. I like giving you the bulk of the work here, but this sort of fits your 2x2 grid, right?
Oh, I very much appreciate it, and I also like the symmetry. Thank you. Just to dovetail on kind of finance a bit, right? If we look at people, process, technology, um, those are all, each one of those individually is going to likely improve, right? But the financing piece is the only real guaranteed outcome, if you will, right? When we think of kind of decoupling the receivable from the actual receipt, from the payable, that is going to help create that certainty. So if that's the primary factor, that might be a good thing to look at, right? Technology is going to help drive visibility. It's going to help reduce errors. It's going to help enable you to collect faster and on time. That's only as good as the process that you configure it within it, right? We always, when we're deploying our software solutions, the software is only going to increase the visibility and speed of a bad process, right? So you want to optimize the process going into that, from a configuration standpoint. And the people, I mentioned earlier, just, a lot of times when we're talking to organizations about kind of a managed service, solution, in addition to our software solutions, it's a lot of times because the collections people are salespeople, right? or it's a part-time job that that they're kind of not optimized for. Obviously, larger organizations have in-house collections teams, 72% according to this audience, where that might be a core competency, but it's certainly key and critical to ensure that you have the right people in the right seats as it relates to receivables to optimize that DSO.
Great. Now this chart, this is the big one. I really want to hear some of your comments on that. On this Venn diagram, we've got the orange color finance, different ways of gaining capital. We've got software and technology in the green, and then the blue, people and processes. So you can see where there might be some intersections with tech and finance and people and processes. And then you've got, in the center, three wedges. Three wedges. You got working capital tech. We got business process outsourcing, central solution, and alternative financing. Maybe give us a quick overview of how to think of how these elements might fit together in terms of decisions that companies make if they're outsourcing a piece or using new tech.
Yeah, I think whether you're outsourcing, introducing new technology, or both, I think the process piece is key to that, right? Because you want to, the labor arbitrage is going to be a hit, right? But you're not going to optimize, whether that's your in-house resources or external resources without getting the process right. The process issues we saw, I think, back in the first survey is one of the biggest problem areas, right? Whether it's billing errors or inefficiencies related to process. So that's kind of key to both of those. And then, this, I kind of went back to the 2x2 as far as like whether outsourcing makes sense, for your organization or not. A lot of organizations are really good at leveraging software solutions and getting the benefits of visibility and automation. Some organizations just aren't very good at utilizing software solutions, right? And adopting them and managing them and maintaining them. But I think there is a bit of table stakes to you need to have some level of visibility and automation to compete. And then I kind of alluded to it before, and I know we're running out of time, but the financing piece is something that can really help drive that certainty by kind of decoupling that billing and the receipt of cash, and having an intermediary ensure that you're getting paid kind of on time every time. And so when you kind of bring all three of those together, you've really got kind of a cure for the visibility and automation, the kind of core competency team, and the financing to drive certainty.
Excellent. That brings us to our final thoughts. And we have, by prearrangement, divided them up as Anthony, Craig, Anthony. So go ahead, Anthony.
Yeah, and I think I stole a little bit of my own thunder, right? But that certainty around when is the cash coming in and how much is it going to be is sometimes just as important. Sort of when is it going to come in is sometimes just as important as how much, right? And I love the Yogi Berra quote. Predictions are tough to make, especially about the future. I think that's something that should be, that should be considered, right? There's always an opportunity to, leverage technology and improve visibility and automation, with the goal of improving DSO, right? But there's an element of certainty that I think should be taken into account when you're evaluating potential AR solutions.
In the partnering section here, I'll just bring up one key point there is when we talk about optimizing front office and back office, there might be some, you may not want to give up some of your customer relationship, customer service activity, especially with your larger customers, maybe the 12% that make up 92% or whatever the percentage is. But there may be some components where you can optimize things, not just with automation, but on an outsourced basis. But look at those. How do we optimize front office and back office? Where do we need to create some stratification to see how can we handle those in a way that maintains good relationships and efficiency? And so that's oftentimes the way to do it. I'll flip it over to you, Anthony, for the last one.
Yeah, I think that last bullet in that middle box kind of perfectly kind of relates to the opportunities for improvement. A lot of times we see kind of a lot of lift and shift, right? Where you're kind of just lifting kind of what you're doing today, shifting that work elsewhere. You're not really getting any better for it. And I think the other thing that I'll leave everybody with is, there's a tendency to rush towards automation, which assumes that your current state is a constraint and that you just simply need to automate what you're doing today. I like to start with elimination. How many of these points of failure can we eliminate before we start automating? That kind of ties into what I was saying about process earlier. And looking at that kind of holistically and comprehensively, right, without the presupposed, solution in mind or the current state as a constraint, I think will lead to more optimized outcomes. Optimized being the word of the day today.
Excellent. Thank you so much, Anthony. Thank you, everyone, for joining us. Brian has a few quick, important announcements at the end, so please stay for those. And again, thank you for joining us. Brian?
Thank you, Craig. Thank you, Anthony. And thank you, everyone, for joining us today. The CTP credits, today's webinar slides, and a recording of today's webinar will be sent to you within 5 business days. And for more on accounts receivables, be sure to listen to the Treasury Update Podcast, episode 248, by clicking the link in the chat box. Thank you, and we hope you have a good rest of the day.